5 of the world's largest technology companies are preparing to spend more than $1 trillion on artificial intelligence in just 2 years. Not on science fiction. On chips, data centers, power grids, cooling systems, and the physical machinery needed to build artificial intelligence at global scale. Some believe this is the beginning of a new industrial revolution. Others believe it is the largest technology bubble since the dot-com era. But what if both are true? Artificial intelligence may transform the world and still become one of the most expensive investment mistakes in modern history. The real question is no longer whether AI works. It does. The question is whether it can generate enough profit quickly enough to pay for everything now being built in its name. This is the AI bubble. In November 2022, a simple chat window changed how ordinary people understood artificial intelligence. For decades, AI had operated quietly inside search engines, recommendation systems, fraud detection tools, research laboratories, and industrial software. Then, generative AI placed the technology directly in front of the public. A machine could write an essay, summarize a contract, generate an image, explain computer code, or answer a complicated question within seconds. The experience felt immediate, personal, almost magical, and investors understood the implication. If machines could perform part of the world's cognitive work, AI would not simply become another software product. It could become a new layer beneath the global economy. Every company would need models. Every model would need computing power. Every unit of computing power would need advanced chips, and every chip would need electricity, cooling, networking, land, and enormous data centers. A digital revolution had suddenly become a construction boom. The race began. By 2026, the Bank for International Settlements estimated that the 5 largest hyperscale technology companies were set to spend more than $1 trillion on AI-related capital investment across 2025 and 2026. $1 trillion. That is not a stock market valuation, it is planned spending on physical infrastructure. In one quarter, Microsoft reported capital expenditure of $41 billion. Alphabet reported almost $45 billion. Meta projected that its capital spending and finance lease payments could reach between $130 billion and $145 billion during 2026. These companies are no longer building ordinary server rooms. They are constructing industrial systems measured in gigawatts. Facilities capable of consuming electricity on the scale of entire cities. Networks containing hundreds of thousands of specialized processors. Machines designed to train increasingly powerful models and deliver them to billions of users. At the center of this expansion stands one company, Nvidia. In the quarter ending in April 2026, Nvidia reported revenue of $81.6 billion. More than $75 billion came from its data center business. These figures reveal something important. This boom is producing real revenue. The chips are real, the demand is real, the customers are real. And many of the companies buying them are among the most profitable corporations in history. This is not a market built entirely on imaginary businesses, but real technology can still attract irrational investment. The internet transformed civilization. The dot-com bubble still destroyed enormous amounts of investor wealth. Those two facts do not contradict each other. They explain the danger. During a technological revolution, investors are not only buying what exists today, they are buying a story about tomorrow. And the stronger that story becomes, the more money begins chasing it. Executives fear appearing cautious. Investors fear missing the next dominant company. Governments fear losing technological leadership. Competitors fear being left behind. Soon, the question inside boardrooms is no longer, how much should we invest? It becomes, what happens if our rivals invest more? That is how competition becomes an arms race. And an arms race does not require every participant to earn a good return. It only requires every participant to believe that stopping would be even more dangerous. The optimistic case for AI is powerful. Artificial intelligence is already improving productivity in specific tasks. One major study involving customer support workers found that access to a generative AI assistant increased productivity by almost 14% on average. AI can help programmers write code. It can assist researchers with information. It can support doctors with documentation. It can help businesses with translation, customer service, writing, analysis, and search. Adoption is also growing rapidly. Across countries with available data, the share of businesses reporting AI use increased from 8.7% in 2023 to 20.2% in 2025. Business adoption more than doubled in 2 years. But that figure also exposes the gap. Even after rapid growth, roughly 4 out of 5 businesses were still not reporting AI use. Trying a chatbot is easy. Rebuilding an organization around artificial intelligence is much harder. A company may spend millions on an AI system, only to discover that employees use it occasionally, customers refuse to pay extra for it, and the promised savings never fully appear. Companies must retrain workers, reorganize workflows, protect private data, manage legal risks, and prove that the technology saves more money than it costs. The spending is happening now. The productivity gains may arrive much later. Economists have seen this pattern before. Transformative technologies rarely improve the entire economy immediately. Businesses first have to build supporting systems, train workers, redesign operations, and discover where the technology is genuinely useful. Researchers sometimes call this the productivity J-curve. At first, investment rises while measured returns remain disappointing. Only later, if the transformation succeeds, do the productivity benefits become visible. The optimistic view says the world is still in this expensive construction phase. The infrastructure must be built first. The profits will come later. But the cautious view asks a harder question. What if the eventual gains are smaller than investors expect? Some economists predict enormous productivity improvements. Others are far more cautious. Daron Acemoglu has estimated that current AI capabilities may raise total factor productivity by no more than approximately 0.66% over 10 years under his central framework. No one knows the final result. But markets are committing capital as if the result will be extraordinary. Then there is the physical limit. Artificial intelligence is usually described as if it lives inside the cloud. But the cloud is not weightless. It is concrete. Copper, silicon, steel, water, and electricity. The International Energy Agency projects that global electricity consumption from data centers could reach approximately 945 terawatt-hours by 2030, almost twice the level recorded in 2024. Globally, that demand may remain manageable. Locally, it can overwhelm existing infrastructure. Data centers cluster near fiber networks, available land, skilled labor, and reliable electricity. A country may have enough power overall, while a particular region lacks the transmission capacity to connect another major facility. Transformers take time to manufacture. Transmission lines can take years to approve. New power plants cannot always be built at software speed. An AI company may design a more powerful model within months. The electricity system may need years to support it, and the processors themselves may age quickly. AI may change everything, but changing everything is not the same as paying for everything. The internet was real. The dot-com bubble was real. The railways were real. Railway investment manias were real. Transformative technology and destructive speculation have always been able to exist at the same time. The question is not whether artificial intelligence has a future. It does. The question is who has paid too much for that future, who has borrowed against it, and whether the profits will arrive before the bill comes due. The trillion-dollar boom is already under construction. Now, the future has to justify the price.